Mr. Nilesh Kambli, the CFO at Star Health and Allied Insurance Company, joins us on the show. Hi, Nilesh. Thank you so much for making time and speaking with us. Just wanted to begin by understanding in terms of the growth, because what brokerages are saying that the gross written premium growth has been steady at 20%. And retail is something that you have been focusing on, but incrementally it seems that the focus is on SME as well as banker group business. Talk to us about how this will pan out for you.
Yeah, good afternoon, everyone. Thank you for having me on the show. For the first quarter, we have grown by 20%. 19% is the growth in retail against the market growth rate of 18%. So we continue to grow higher than the industry growth rate and continue to improve on our market share, which is 32% now. In terms of group business, we continue to focus on SME business, which is profitable. The loss ratios are pretty comfortable. The combined ratio is pretty good. We don't want to be in the large corporate segment, which is not making profits for us. Banker channel, we are very, very optimistic. We have signed up a new relationships with AU Small Finance Bank, with Godrej Finance. So we are expanding our relationship in this segment, and which will help us to grow in this segment. It's a profitable segment. Benefit product contributes very high in this segment. We are growing by almost 50% over the last 3 years, and that's our focus area.
Vacate the wholesale insurance bracket and you move to retail, could there be a dip in top line? Could there be a dip in aggregate numbers? While you may grow at retail level, but if you are vacating a wholesale business, it will come at a cost of top line.
So that has happened for us last year. From a 10% contribution from group health business, we have shifted to 6% contribution. So we have already vacated that space. The base is set for the current year, and from here we'll continue to grow in this segment. The idea is, along with SME and banker group business, we'll operate in the range of 10 to 11% on a scale of 100. So 89-90% will be the retail business, and around 10 to 11% will be group business for us. But that reduction has already happened for us last year.
The combined ratio worsened this time around. It came in at 98%, and if I have it right, your guidance for the full year was 93 to 95%. Are you looking at a sizable improvement from combined ratio here on?
See, we need to understand that this is a seasonal business as well. What is comparable is last year Q1 we had a combined ratio of 98.25%. This year the combined ratio is 97.8%. It's a 0.45% reduction in the combined ratio. Our loss ratio has improved by 0.9%. Expense ratio, it's again, the base is lower in terms of premium for the first quarter compared to the full year. And the fixed cost is sequential rather than year on year. So there is always a slight blip in expense ratio in the first quarter, but we are, it is in line with our expectation, and we are well on course to maintain the full year guidance of 93 to 95. We have taken a price increase in our flagship product, which is the Family Health Optima. The renewals are, in line with our expectations. The benefit in terms of earned premium, which, impacts the loss ratio, will come in the second half. So that will again improve our combined ratio. So, to keep it short, we are well on course to achieve the full year guidance of 90 to 95.
So if you move to a number closer to 93% on combined ratio, and just I'm bringing this benefit for our viewers here. Two ways insurance firms, they make money. First, the premium. Second is the total kitty which they get, and how are they able to run the treasury operations. If the combined ratio is more than 100, that means the insurance company is spending more than what they are actually earning. That's how I'm trying to simplistically, make it sound eligible for our viewers. Now, if you move from 97.8 to 93, that means you are making money in your insurance business also. So what will be the impact of that? Because that will be operating leverage which should kick in, right?
Yes. So to give a context to it, last year we had our combined ratio at 98.2%. For the full year, we ended at a combined ratio of 95.3. Q4 is the best quarter in terms of loss ratio. Our combined ratio in Q4 was around 92%. So as the year progresses, there are quarters where we'll have a slightly higher combined ratio and loss ratio, and then there are quarters where we have lower combined ratio. To give a number, last year we had achieved the underwriting profit, which is the operating profit for insurance companies, at 205 crores. The industry as a whole has lost 31,000 crores. The insurance industry, the GI players and the health players put together. So this year also, with this kind of combined ratio in Q1, we are well on course to achieve underwriting profit for the current year, along with the investment income. So we have a investment book of 13,300 crores. For the first quarter, we had a very healthy yield of 7.4% roughly, with an investment income of 250 crores. So both on operating side as well as investment yield side, we are doing profits.
Impact of high medical inflation. Everybody now wants to go to a better hospital. Because you have insurance, you want to perhaps afford the best you can get in that insurance bracket. And there is a serious medical inflation. How are you passing it on? By a simple price hike in your premium policy, is that been taken care of?
Yeah, so there is a multi-pronged approach when it comes to inflation. We have taken a price increase to counter it to an extent. What we are doing is we are negotiating well with the hospitals. While the price increase is slightly higher in the urban areas, in the semi-urban rural areas, there is not much of an inflation. It's a function of negotiating with the hospitals. It's a function of the volumes that we do with the hospitals. And we are able to negotiate some rate really, really well. So the overall inflation in our portfolio, we don't see much of an impact because of this price increase which the hospitals are taking. It's a retail business again. The element of fraud is very, very prevalent. With the kind of claims we have settled over the lifetime of our company, we have settled more than 90 lakh claims. We have a lot of intelligence and knowledge. We have developed systems which gives us triggers so that the benefit coming through the fraud control and management, that has been gradually increasing. So while price increase to manage claims ratio is one part of it, there are a lot of efficiencies, in terms of the hospital rate negotiation, in terms of fraud control and management. That is also helping us to maintain the overall profitability of the business.
Nilesh, just last question from my end. You talked about the price hike that you had taken, but any more on the anvil? And secondly, your operating expenses have shot up very, very sharply, both in terms of employee and other Opex. What's the sustainable expense ratio you're looking at?
The first question was in terms of,
in terms of you already took a hike. Are you looking at taking more hikes in your products?
Yeah. So in terms of price increase, what we do is we manage each and every product separately. Whenever a product touches a particular loss ratio levels and profitability or loss ratio levels and the profitability reduces, that is the time when we go in for a price increase. We continue to evaluate it. Currently, we don't see something in the immediate near future, but as and when the loss ratio increases, we'll take the price increase. To answer the question on expense ratio, if you look at our expense ratio, it is 32.4%. Vis-a-vis last year, it is 32%. And as I explained, the fixed cost is sequential. So the kind of investment that we have made in people and technology, that is slightly higher compared to the GWP that we achieved. But we believe that as we go on, this fixed cost will remain stable. The premium growth will continue to happen. So we are very, very confident of achieving the full year target of expense ratio close to 30%. And there'll be slight reduction or stable expense ratio compared to last year. It is basically the investment in people, technology. The digital business is doing well for us. We continue to do performance marketing on social media. So that is where the cost is taking place.
Let you go on that note. Appreciate you joining us on the show. Quickly, just wanted to mark a couple of stocks that just reported numbers and seeing big reaction. Dhanlaxmi Bank has seen a big spurt, and that's because the asset quality has improved. And if you look at the interest income, that too has increased for the bank. So as a result of that, that stock has shot up around 8%. On the losing side, it's Castrol, which is coming under pressure. So that stock is down in the trading session. It's down about 2%. And then, of course, Wellspun India reported a very strong set of improvement in the profitability and margins. So Wellspun India, the last time I checked, was up around 10%. Look at the spike on the counter, now comfortably above the 110 mark. Let's